How much returns can an investor expect from a mutual fund investment? Our chief financial planner, Mr. Ramalingam, will guide us through. Ramalingam, the screen is yours.
There are three major categories of mutual funds which are there in mutual fund industry. One is fixed income based, which we call it as debt funds. So in debt funds, the return what do we get is based on two parameters. One is for how long you want to invest and what is the market rate. If you are investing for 3 months time frame, choose an ultra short term fund. If you are investing for 1 year, choose a short term fund. If you are investing for 3 years, there are 3 year based accrual based duration funds are available. You can choose that. So return is based on how much time frame and also market rate. Market rate you can take it as FD rate. FD rate plus 0.25 percentage. That will be the kind of return expectation which you can have when you invest in a debt fund. Debt fund will not give you, like super duper return. No, debt funds in an only in an extreme rare situation can give you two-digit return. Generally, debt funds will give you similar to your FD kind of returns. So from debt funds, have an expectation similar to FD returns. As far as equity market is considered, equity market depends on stock market. If you look at how much return Sensex or Nifty has delivered, between 2013 to 2023, if you look at Sensex has delivered 12.5 percentage return. 12.5 percentage is CAGR in the 10-year time frame. Nifty has delivered a 12.65 percentage return in the 10-year time frame. Sensex and Nifty are large cap indices. A mutual fund, actively managed equity fund, will invest in good stocks, will not invest in the entire index. That way, if you look at it, actively managed funds will try to outperform the index. They generate additional alpha. In that case, they could have delivered much higher return than this. Also, they'll be investing in mid caps and small caps also. Again, it will be an additional return for you. So, in the last 10 years, index has delivered 12% plus returns. Your equity funds should have given you minimum 15 to 18% kind of returns is what it would have given you. Having said that, what kind of returns we can expect? On a conservative basis, we can expect 10 to 12% because last 10 years, India has grown from point A to point B. Now, like we are moving from point B to point C. Our base is higher now. We can't like having an expectation of 15 to 18 percentage may not work in the next 10 years. Having an expectation of 10 to 12% is reasonably a good expectation to have. If you are getting more return than 12%, it is well and good. Third asset class through which can be invested through mutual funds is gold. Gold historically has given an inflation meeting return. Maybe in the last 2 months, yes, gold has given a very good return. But if you look at the last 10-year, 15-year, 20-year, 30-year average, it has simply given inflation meeting return only. So whatever is the long-term inflation, say generally 6 to 8% is the inflation rate. So gold will give you similar rate of return only. So debt funds have FD kind of expectation. Equity funds 12% kind of expectation. Gold you can have inflation 6 to 8%. So this is the kind of return you can get from mutual funds.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.